again. I keep thanking Jessica for joining us because she told us when she joined a few minutes ago that she's actually under the weather. And I was like, we could have rescheduled this. So I'm so grateful to her being here for feeling under the weather and all. But Jessica is a capital formation advisor. She's been in the industry for a good long while, well over 15 years of experience, and loves connecting folks around the world. It's a very successful fundraiser. And like I said in my newsletter intro, she is one of the cool kids who's a fellow Georgetown MBA. So all Hoyas are good by me, my spouse included. So thank you again, Jessica, for being here.
Thanks for having me, Vonetta.
So I want to kind of jump in, but basically to level set. And it feels like, every level set that we've had at the roundtable, starting with Brian's in March, I've been like, so can you give me your perspective on how things have been going in 2024? Because I still get the impression that things have been pretty weird. So can you give us your sense of where things stand in terms of the fundraising market?
Yeah, I think that, we talked about it a little bit before we got started. The market is still kind of in a defensive mode, and there's, lower activity than folks would expect on average over a longer period of time. LPs are really focused on their existing roster of managers, and they're really, spoiled for choice, meaning they have more opportunities to invest than they have capital available to deploy. And I think a lot of that is driven by just kind of like the kind of frenzy and ebullience of the last couple of years as the cycle came to an end in 2022. I was looking at PitchBook from the 10 years from 2012 to 2022. Venture capital AUM grew 9 times. So assets under management in the sector grew from 430 million all the way to 3.8 trillion. And 60% of that growth came in the last year between 2021 and 2022.
Wow.
And then, so that was, those were kind of.
Did you say 60% of that growth came over the course of like a year or two?
Yes.
That's wild.
Yes. So there was just like this frenzy that culminated in the 2021 to 2022 timeframe that came to an end in about April, May, and June of 2022, kind of like when the 9% inflation print started to kind of settle in and people realized that rates were going up and, that wasn't sustainable. But it had been a long run. It had been 10 plus years, basically since the financial crisis when, zero interest rates were driving investors farther and farther out on the risk curve, and people were seeking yield, people were seeking growth at all costs, et cetera, all the themes that we're now familiar with. And, so then there was just like a reset. And I think there was a reset in 2022. 2023 was a time of people kind of accepting that reset. And at the same time, going into this year, we still have very, very low exit activity. So the IPO market is kind of barely functioning. There's been a couple of IPOs recently. It's starting to have like a phased reopening, if you will, but there's a huge backlog that needs to be cleared out in the market in terms of exits and capital being returned to LPs before they really kind of get off the sidelines. That being said, I do feel that in the past couple of months, there's like a thawing that's happening where LPs are more willing to engage. I mean, one of the managers I'm working with, like, we have the most momentum in the last couple months that we've had in a year. We've raised 75 million of $150 million fund, and we have, a dozen plus investors that are, in deep due diligence and are kind of like waking up saying like, we were following the story, and now that we see that you're going to get across the finish line, like we want to do our work more deeply. And at the same time, like that catalyzes other investors. Like once, there's kind of this tipping point that happens. And so I feel that thawing is occurring now. But yes, 2024 is still like a tepid, kind of market hasn't found its footing yet.
Yeah, yeah. And I keep describing it as, no one has been fundraising, but I know that's not true. We were talking about increase in raising this really huge fund, and there actually have been some smaller managers who have been successful, not a ton of them. So what do you think really differentiates the people who have been able to fundraise in this environment from those who haven't?
Yeah, and I think in terms of the fundraising data, I think there was like in 2023 there was about 70 billion raised across 500 VC funds. And like that was compared to the like 3.8 trillion, you know what I mean, that had been raised in the previous decade. So for anyone that feels like, oh, it's not working, like I'm pushing a boulder uphill, like everyone is pushing a boulder uphill. And so it's about kind of resetting your expectations around fund size and what's realistic and um, that kind of thing, because it is a really tough fundraising market and capital is more scarce than it was, and it's going to remain more scarce. Um, so the folks that have been more successful are, I would say, and this kind of goes to another question you had on your list, which was like, what do I look for in clients? Which is like sector specialists. I think that LPs are kind of done and averse to the kind of software generalist. I think sector specialists with like deep technical expertise in whatever their field is, whether that is in climate tech or in fintech or in agriculture or something very narrow and deep. And it has to obviously fit the LP's investment thesis, but definitely sector specialists who have returned capital. You know what I mean?
Mm,
And I think DPI is kind of the like three-letter word, which is distributions, and cash return, because LPs are just kind of skeptical, especially institutional LPs are just more skeptical around marks. They don't want to see the kind of game of hot potato where like one venture fund is marking up the deals of the last venture fund, and the public markets ultimately are what determines valuation at the end of that game of hot potato. And luckily for private companies, the public markets have come back and are at all-time highs, which is great. So that feels good. And that feels like, okay, we start feeling a little bit like risk on. At the same time, managers need to have returned capital to demonstrate their ability to invest like across a whole cycle from, when LPs are looking at managers, they're like, can you access the deals? Can you select the great deals? And then actually, how do you manage the portfolio for liquidity? And that's hard because a lot of folks are like, no, these are great companies. We want to hold on to them for as long as possible and have our dollars compounding, in the private markets for as long as possible. We don't want to sell secondary because we have high conviction around our portfolio companies. And LPs want to see that you can return capital. And so, there is an opportunity to like, even if you have really high conviction, to like take some money off the table and, sell some secondary of a larger position you might have as a GP. Just to show that you kind of know how to do that, that you are an investor and it's not just about being a technology person that writes checks.
yeah, no, that makes perfect sense. And I think it was Marty DePiece actually who told me when we're at a conference, she was like, DPI is the new IRR. So I was like, that is interesting. And I mean, it makes perfect sense. It makes perfect sense. I kind of related to that, want to touch on something that we were talking about earlier in terms of, there are folks who have been fundraising for a while. They might have kicked off at the end of 21 or beginning of 22, might have had some good traction to begin with, and things slowed down demonstrably. And you have this, LPs wanting to see capital return too, which is going to be hard for someone who has not finished raising their fund yet. So what advice do you give to folks who are still in that muck? They might have been in the fundraising muck for 2 years, 2.5 years at this point. What can they do to, kind of move forward? Or, I mean, I'm not saying are they screwed, but are they screwed?
Yeah, I think it depends. There's a bunch of regulatory stuff around this as well. Like if they're an exempt reporting advisor, if they filed a Form D, usually there's like a clock that's ticking where they have 12 to 18 months to raise the fund after they file their initial Form D, which is like the offering of securities. And so that will all be in their LPA, what type of like, are they an RIA? That, all of that regulatory stuff they need to work out with counsel, and they need to understand what's in their LPA, which, people don't love reading these documents, so they may not have looked. Um, and at the same time, like, say they do have 2 years or 2.5 years or something, ultimately, I think it's executing on your business plan as a GP at whatever size. What you have to figure out for yourself, like, what is your minimum viable fund size? What are the minimum fees? There's a lot of outsourced tools and things, whether that's fund admin or Carta or, different things that are not very expensive. So you can kind of run a fund. There's like a fund in a box kind of thing. Like, you just, it's about um, the GP or two or three that are finding the deals and writing the checks. And maybe you have to write smaller checks, but you're demonstrating, like, this is our investment thesis. Like, this is, yeah, we do have access to these deals. Like, we do have a proprietary network, or we do have an edge of some sort. And can you demonstrate that under these circumstances, whether that's a $10 million fund, or, I have someone that was talking to me about helping them fundraise. It's a first-time fund manager, was first time fund manager, first time investor, and they have someone that wants to give them $10 million. And I was like, that's a fund. Like, just go invest that, you know what I mean? And do a proof of concept. Like, you don't, because the person was like, do you think that, like, net new investors would invest? And I said, in this environment, I don't think so. You know what I mean? Like, I don't think that anyone you meet today is going to invest with you as a first time investor in a first time fund in this, like, kind of very specific investment thesis in the next 6 to 12 months. Like, they might get there, you know what I mean? But start investing. $10 million is fantastic for a first time fund manager that's writing seed checks. So just go with that, And so I think it's about being realistic about, like, what you can do within your business plan and your investment thesis with the capital that has been committed. And Evelyn mentioned this, right before we started, that sometimes you just have to close the fundraise and wait for kind of the headwinds to pass. And, there will come a day when people are risk on again, and you just have to kind of wait it out.
Exactly. I think that that does require a level of humility. But I think that has been kind of the theme that I've seen in this market, has been very humbling for folks to, really have the strength to say, this is what I want to do, therefore I'm going to stick it out. Or, you know what, maybe I will, as we were joking earlier, get a job and come back to this in a few years when I think will be a bit better. But no, it's true. It's just, I think there is a such thing as practical optimism, but I think there is also, respecting what works for you, for your family, for your network. Like, how do you make this work for you? And just being, realistic and honest about that. Yeah. Did you want to add anything?
No, I was just going to say, yeah, the market speaks, you know what I mean? Like, the market finds its level. Like, there is a market clearing price for things there. So, sometimes that we might think the market is irrational or they don't get it or whatever, but it is what it is. Like, there's the macro backdrop of just less capital available, higher rates, and they're not that high, by the way. I mean, I was looking at, there's a quote from a Sequoia Capital partner, and he said, it's the end of easy money for sure. But if we go back in history, Sequoia has more than 50 years of experience. They invested in Apple in 1978 when the 10-year yield was over 8%. Today it's like at 4.5%. They invested in Cisco in 1987 when the 10-year yield was over 8%, and in PayPal and Google in 99 when it was over 6%. And we're well below that level. It's just a whole generation of investors and market participants have never seen any interest rates. They've just,
Exactly.
that is the unnatural part, actually. It's not, 4% interest rates are not abnormal. 5% interest rates, not abnormal. When our parents were buying homes, mortgage rates were 16%, and it's like now people's mortgages are 5% and they're freaking out. So I think it's all about, like, that context of, like, I've been working in the capital markets, as you said, for over 15 years. I've worked in all different areas of the capital markets. The majority of my career was spent at Citigroup. Half that time was with infrastructure investors in the power sector, and half that time was in the asset management division. And so, like, I'm a student of markets, and I can look back not just on my 15 years, but on the last 100 years, the last, 150 years, and say, okay, like, what has happened in different times? Like, there's nothing new. There are market cycles where there's just like ebullience and kind of irrational exuberance, and then there's a pullback of that, and there's a risk off time, and then there's a time again for um, to take advantage of opportunities again. And this market is just taking time to recover.
Yeah, no, that makes perfect sense. That makes perfect sense. And you're so right. I do sometimes think about, what does it, obviously, we have all only lived in the time in which we've lived, unless you believe in reincarnation, of course, but it's, of what we remember. This is all we remember. And we don't have very many points of reference, or maybe we're not decision makers. The 30, 40 years ago to have the experience of what we're experiencing now, which is really interesting. And we bought our house in 2020. So even a 5% mortgage rate kind of like made my heart stop a little bit, but I won't, brag about what our rate actually is. Just want to bring it kind of back to basics a little bit. So I know everyone basically knows what a placement agent is, but just so we are all clear, how can a placement agent help someone on their journey, whether the times look more like they did, back in 2020, or where they are now? And I guess even more importantly, how can a placement agent be helpful and useful when someone is between fundraisers? Like, what does that relationship look like?
Yeah. Yeah, so a placement agent is basically a broker, and there are different forms of arrangements. I get paid a retainer plus a percentage of assets raised, and I have my securities licenses, and they're affiliated with a SEC compliant broker dealer, which is required to kind of charge clients transaction based compensation, which is the percentage. And so I think that is something that not everybody always knows in VC. Like they'll have people that say, oh, I can make intros for you. And, I'm not against that. I think that people should be registered and there could be clawbacks, and there's different things that the SEC is interested in depending on the size of that activity. But I think it is important to understand, like, if their person is, has their licenses, and then also to do like a FINRA broker check to see if they have any disclosures. It's something that I've always done whenever I've been working with people. Like, I want to know, they might have disclosures on FINRA broker check, which you type in their name, and that's their kind of what's called a U4 form. Is a securities industry participants have a U4, and you'll see if anyone has complaints against me, or, and that's okay. Sometimes people have complaints that rise to the level of the SEC or FINRA, and that could be something that could be explained. Or if they have like a lot of complaints, or reprimands, like, I would steer clear. And That's one thing from a regulatory perspective that I always tell people to look for. And then how is it helpful? Well, an investor's job is to be an investor. You know what I mean? In every other area of the private markets, whether it's buyout or real estate, or private credit, debt investors, they are subject matter experts on their asset class, and their job is to find great deals and underwrite great deals in their asset class. And then they partner with someone whose full-time job is essentially sales, and it's fundraising, it's understanding the LP landscape, which is a constantly moving target, who's writing checks into what at any given time. No placement agent or fundraiser can be in all places, but we have relationships, and usually a proprietary network of some sort, where we just have like market intel that's not available anywhere else. You know what I mean? I had a call this morning with a sovereign wealth fund in Europe, and just kind of a catch up. And they were telling me, like, okay, our mandate has actually been refined since we last caught up. And this is what we're looking at. And this is the things that are most important to us. And so those are just things that are, need to be kind of tracked and put into a process by someone whose whole job is to understand what investors are looking for at any given time, and try to help both sides of the table have a mutually beneficial relationship, and to bring those folks curated deal flow, curated managers that can meet their hole in their portfolio that they are looking to fill.
So what is that communication like between, the placement agent and LPs, or well, and the placement agent and GPs, obviously. But I'm more curious about the LP side when they're not fundraising, but obviously, this is still a relationship, and that's why I love this business. Every aspect of this business is a relationship, including the one that GPs have with their fundraisers. But what does that look like in terms of like, well, is it that you're, just in ongoing conversations with their LPs about those GPs specifically, or does it tend to be more a high level of what's going on in the market more generally?
You mean from the perspective of how I interact with GPs in between fundraisers?
Mhm.
So there's different things you can do. I always say it's kind of like a political campaign, like being a fund manager, it's like a political campaign. Like you need to have like name recognition, you need to build relationships with your constituents, you have different kinds of constituents, you have, founders or portfolio companies, and you have LPs. I think during the last bunch of years where it was not hard to raise money, a lot of GPs were like, oh, LPs, like we don't, the money just comes. And actually, like there are times when the money doesn't just come, and you need to use those years and that time um, when you're not fundraising, right? It's like when you're looking for a job, the best thing to do, the best time to look for a job is when you're not looking for a job.
Right.
It's just you're building relationships with people are getting to know your skill set. And then when it's time, you have more, there's a foundation. It's not cold. And so I think that GPs always need to be building those relationships. And there's different things we can do together, whether that's like, every 6 months we have a dinner and we invite different types of thought leaders, and they basically showcase like what they're doing that's unique and interesting, what they're seeing, because LPs want that. Another LP I talked to recently said they love LP teach-ins. LPs love to meet other LPs. That's another thing. There's different types, of course, right? So if you're university endowments, they like to know what other endowments are, what's like new on your radar kind of thing. CVCs, same thing. Like there's very specific CVC kind of sectors, but like in energy transition, for example, like they need to know like what are our competitors investing in that's going to be like the future of our business as we decarbonize. And that's kind of like, a bit of a blank slate. Like there's a lot going on in that space, and there's a lot of technologies, and people are, long different areas, and they want to communicate with others around deal flow. And one thing you can do as a GP, and I can help GPs do as a placement agent, is make those connections, is like build those relationships in the kind of in between time between funds, and add value to like the ecosystem, if you will. You know what I mean? There's kind of an overdoing it. Like, I don't think you need to like be at every conference and be at every happy hour and all that good stuff. But as a GP, you can serve a very important role as a convener of folks that may not otherwise know each other, but would benefit from knowing each other, would benefit from knowledge sharing, would benefit from, knowing what each other's investment theses are, what their structure is, and all that kind of stuff.
I love that. And maybe it speaks to me as a convener, as you all are here in my roundtable, but I
Yeah.
think that so much speaks to, I think it speaks to kind of a little of what we were talking about before, but like differentiation, and what that kind of quote unquote proprietary deal flow means now, which I know if a GP says that, LPs kind of laugh in their faces immediately. But I think there is something to be said for very intentionally building your network, and seeing that yes, you're not just getting money from LPs, but LPs want to learn from you. They want to know you better. They want to know your sector better. And they want to grow their networks too. So that makes so much sense. That's a really, really great point. I love that.
Yeah, and the annual meeting is another thing, like an AGM, annual general meeting, which is, generally required in most LPAs. But some people do it like, on Zoom, or it's just kind of like, a newsletter or something. I think being in person, I think because people are working hybrid most of the time, most of these folks are working in some hybrid capacity. I think convening has become even more important in person. Like we just did an AGM for one of my clients in Boston, and it was oversubscribed by the LPs. Like we had to turn away LPs because we couldn't fit more than 300 people in the in the ballroom. And that's a great problem to have. But this this GP hasn't had an AGM since 2019. So people were just like so eager to come together with them. They're very well regarded in their sector. People think of them as a thought leader, and they wanted to hear from them. And also at an AGM, you have your portfolio company like CEOs speaking and that kind of thing. And it's just, it's just it's an intensive way to learn a lot in a short amount of time and also be together with folks that are your partners.
Exactly, exactly. I want to take it back to another question, because related to LPs, another question we were talking about before we started. Evelina had got us talking about kind of the difference between LPs. Like, yes, it is an LP, an LP, an LP. No, a family office is going to be actually very different from a fund of funds, which is going to be kind of different from, from like a pension. So Jessica, can you tell us a little bit more of, like, from your view, what are kind of some of the differences between these different types of LPs, and what might they be from your perspective as a placement agent as you approach them? Does your approach change? And, how are they looking differently at the world?
Yeah, I think there's a lot of different types of market participants on the LP side, and it is important to understand as a GP when you're fundraising what their motivations are, because like not every LP meeting is as important as every LP meeting, right? So like, and it's I do think from like a time spent perspective, like, are you barking up the wrong tree, like that kind of thing. I think that it makes sense to understand like their motivations, like are they deploying, like what's important to them, and some stuff is publicly available. So you have endowments and foundations, which are typically very large allocators to private markets. It's like the Yale endowment model, where you have up to 60% of all of their assets could be in private assets, alternative assets, right? They have a permanent capital base that is meant to fund future generations of whatever that might be, scholarships in the university, or the Ford Foundation, for example. Whatever the mission of that endowment and foundation is, a lot of times is related to university. It's a permanent capital base that's in perpetuity. So they don't care about time, they care about compounding capital. And then they have their budget for their distribution. So I would put that into bucket number one. Endowments and foundations, they're very similar. Most of them have a website. They file 990s, which is like their tax return, their nonprofit tax return. So you could look at who their service providers are. You could see who their money managers are. Some of them manage the money in-house. Some of them manage out of house. The way that's usually broken down is, I would say, like under $1 billion or under like $2 billion, they generally outsource it to someone called an outsourced CIO, OCIO. Once they get above 1 to 2 billion, they start in-housing those capabilities and managing that money themselves. The next group is, like, I would say, sovereign wealth funds, which for emerging managers are likely too large, like don't even bother. You know what I mean? These are people that need to write $100 million checks with $500 million of expected follow on. So like, like a Temasek or a GIC, CIC in China. I mean, just enormous pools of capital, trillions of dollars that, because of the amount of checks they need to write and the amount of capital they need to deploy every year, they can't write checks that are under, X hundreds of millions of dollars of size. For larger managers, that could make sense, or there might be pockets within some of them. Pensions are, I don't have a lot of relationships with pensions personally. Pensions are a little bit different because that also depends on the asset class. They also write really big checks depending on the pension. Like a CalPERS or a CalSTRS, like they'll give their venture allocation to a fund of funds. Because they don't have the time to diligence smaller managers. They also work with a lot of consultants, and they have a very like formulaic process that can be well understood, by the way, because it's all in the public record. So, that's a good thing about pensions. If you want to learn how to interact with pensions, I haven't really I know pensions, but I haven't really broached that area as much. Fund of funds is another area. I just mentioned that they sometimes have big allocations from pensions. But they again, I always say, I'm so like, I feel like I'm half like glass half empty or something because I'm always like, um, but fund of funds, they're on their own fundraising cycle. So you need to understand, like, are they on the road fundraising or do they just close a fund? Like if they've recently closed a fund, fantastic. They're likely going to announce that fund, 6 to 9 months after they've closed it. But if they've closed a big enough fund, they're deploying. But you need to know, like, there's tons of fund of funds you meet with, and they're just like, hey, we have the same problem you have. Like, we're on the road,
Right.
and it's double layer of fees. So this market has been really hard for fund of funds.
Exactly.
And then there's family offices, and family offices are a group that people always think are like, oh, they're so opaque and hard to penetrate, but once you're in, like, they're really great. And that could be true. The reason I like endowments and foundations kind of the best is because they are deploying capital in a very process oriented way. Like you will know just from looking at their balance sheet how many dollars they're going to be allocating to a specific asset class. If they're over allocated, they have targets, they have an investment policy statement that's usually public. So you can know a lot about endowments and foundations and where, if there's a match, without having to do the work of like scheduling a meeting and talking to them. Now, you always want to be building those relationships, but you'll be like, okay, this is a higher probability because they are looking for what we have. You know what I mean? Family offices are more idiosyncratic. Like one year they might be, oh yeah, we're all in on AI, and then they change their mind, or they have a bad experience, or the patriarch dies and the kids don't like that, and so they're just more idiosyncratic. They are harder to penetrate. They don't like to be sold to. The bigger ones, they have a similar size kind of characteristics as an endowment, which is like if they're over $2 billion, they probably in-house a lot of things, which is good for managers because they'll have a CIO, they have a professional staff, so you can build a relationship with those folks that are, financial professionals and allocators that their job is to take calls from managers and find great ideas and surface those ideas. So, but, and then again, if they're not over 2 billion, they probably have a bank that is managing their capital, like, or some sort of RIA or someone that's outsourced. Yeah.
That is incredible. Thank you so much. I think I tried to write down almost everything you said word for word because I've not heard someone give like such a clear breakdown of, I'm pretty sure you just listed out like 5 different types of LPs. But to see that all of them are so different, and obviously even within each category, everybody is going to be completely different there. So for GPs to be really aware of those idiosyncrasies and all, just to, for if nothing else, to save time, to not bark up, like you said, no need to bark up the wrong tree and to waste both time and money trying to get meetings with
Right.
people who probably won't be interested in your strategy.
Yeah, exactly. I think that's like, like GPs sometimes will be like, I don't understand, like this, it seems like they would be interested in this, but they might not have the dollars to allocate. They might say, well, we're like, the Ford Foundation is a good example. They're so over allocated to venture, and they were in Sequoia 1 in 1972.
Wow.
So like they're a huge pool of capital. I think they have like $14 billion, and they're a huge allocator to private markets, and they're really like highly convicted around venture capital, but they're fully allocated. Like it's going to be years before they write a check to a new manager. And so, yeah, build that relationship. If you happen to be in New York and you want to go swing by and see them, that's great. But I wouldn't fly there to see them, to pitch them. You know what I mean?
Yeah. No, that makes perfect sense. That makes perfect sense. So I, as we all know, can continue asking questions basically all day. So if anyone else has a question, feel free to jump in, or I will very happily keep going.
Yeah, I have a couple of questions. Number one, how do we check that? You said that, if a placement agent offered the service and we want to check, we check the U4. How can we check that? The
I'll put it in the
complaints. Where
chat.
do we go?
Yeah, I'm going to put it in the chat.
Okay.
So on the bottom of all of my proposals, I have a section called regulatory considerations, and I say that, who my affiliated broker dealer is, and I said, for additional information, you can check broker check. And yeah, I mean, we interacted with someone at a prior firm. I was at a prior firm, and I had never seen so many disclosures on a broker check. And I've looked at a lot of broker checks, and I was like, this gives me pause. Like, I don't know like all the details of all of these complaints, but like just gives me pause because I don't have any complaints. But if something does rise to that level, there could be good reason, and there's, lots of things, disputes happen, no big deal. But this particular person that we were engaged with when I came on board had like a litany of things, and it was very alarming. And so, yeah, it's just kind of like you should know who you're in business with. And in the securities industry, that's knowable.
Yeah, and then the other question that I have is, I work with different funds, right?
Yeah.
And I'm the board, and all of them are the board. So we wear a lot of hats. And so I get approached sometimes when I go to conferences by people who work for like Oppenheimer, Stifel, Merrill Lynch, Bapstone. And so they say I think they are like brokers for them, or they are like investment advisors or whatever. But so when I talk to them, I say, look, from my understanding, I mean, I come from the investment banking side. I don't know a lot about the private wealth management business.
Yeah.
But I keep telling them, I say, look, all the funds I'm on the board, they're really small. I mean, no way your investors would be able to invest in those funds. You only can invest in the funds that you put in the platform, right? Isn't this a waste of time when they come like, and I say, and it's now I can talk with I have some families and they can do, I don't think they can do anything outside from what is like in the platform, right?
I think that's generally true. It's true at like the JP Morgans, the Cities of the world. I would think it was also true at Merrill. So what you're talking about is like, I would have clients when I was in private wealth management, I would have clients who were GPs, and they would say, oh, I'm raising a fund. Do you have any other clients who might be interested? And I wouldn't be able to make those introductions because it's a FINRA violation. It's called selling away. The the um the funds that my clients at Citigroup had access to had to be, as you say, on our platform, quote unquote. That means that we had a third-party manager diligence team, and they would look at those managers and say, okay, do we have enough interest and capacity to form a feeder fund for this manager? And like, do they pass the operational due diligence and all this other stuff? It was a long process, and it was a high hurdle. I would often make those introductions to the manager diligence team for my GPs, and I'd say, hey, there's a separate team. They're based here. They're going to do the proctology exam, and determine if your strategy is something that fits with what our clients want, and also if it's big enough, and there's all these other kind of logistical things, administrative things. So yeah, I don't think those brokers, RIAs are probably fine because they're smaller, right? Like an RIA is different. They're not going to have the same level of, they'll have diligence, hopefully. But they won't have the same level. Like an RIA could just be like a handful of people that kind of did a lift out from a bigger platform. And I don't think those are bad prospective LPs. But the big banks, I think, are not necessarily worthwhile unless it's a really big fund.
Bapstone is, I mean, when they come and introduce, they say, so we go talk to them like Bapstone, we are now an $80 billion asset manager. And then you have to, again, you have to go through that team. I mean, we went through that, but I keep telling people, we're wasting our time because I don't think we're ever going to be in that platform. We are tiny, and so I don't know why they go and approach us. It's a mystery. But the RIA you're talking about, Or like those small wealth managers, like they say I'm a multi-family office, and there's like two
Yes.
guys. Those
Yeah, but
guys,
some of them aren't that small. I mean, so, look, I think just like GPs can be like, fund manager in a box, like it's easier than ever to be a financial advisor like in a box. You know what I mean? Like some of these RIAs started a long time ago before there was all the technology. Now there's so much technology. I mean, you just custody at Schwab and Fidelity, and you just provide advice, fee only advice. And if you have the relationships, people go with you. And so some of the RIAs are quite big. And you could do like an RIA search by city and look at which are the biggest and go after the ones that are 5 billion. Like I would look for the ones that are like 3 to 5 billion because they have enough AUM to need product, if you know what I mean. But they don't have so much AUM that they have tons of product. So if they're 10 billion, it's like, they're probably like already very institutionalized. But if they're institutionalizing, if they're in that process of like building out their product suite, meaning how do we fill our asset allocation buckets and what managers are going to be in there? Generally, RAs are going to be passive investors in the public markets, and they're going to be active on the private side, and they're going to do a lot of manager research. And so I think that, those kind of more medium RAs are a good place to look.
That's
and
great
sometimes I
advice.
don't know if they're approaching us saying like, we want to learn about your fund, but they really want to know the GPs, to maybe the GPs will be, that's the impression that
That's what I
sometimes
was going to say. That's
they want
exactly
the
what I was going to
GP to be
say. They
their
probably think the
clients.
GP is an ultra high net worth individual.
Exactly. So it's
Exactly.
hard to like, why is this guy talking to me? And the thing is, they go with that and they really want us to become their client.
Yes,
Exactly.
I
exactly.
think everyone has their fingers crossed for that GPs will become wildly successful. Everyone wants to get in the door of the next Robert Smith before he is where he is now, of course. Now, thank you so much for that question, Evelyn. And I think we had Desiree. I think you might have a question. It's great to see you. It's been such a long time.
It has, and I'm sorry I came on late. So
No,
I'm sure you've covered a variety of topics, but one of the things that I'm focusing on right now, so I'm building a hyper-regional hybrid fund, which is part fund of funds, part direct pre-seed, with the idea of kind of kickstarting our venture economy here in Chicago/Illinois. And one of the things I'm exploring is the DAF side of investing into this kind of fund, just given the fact that it's first-time fund manager in a kind of atypical construct. And I'm just curious if you have any insights on that. I'm already working with impact assets to do
Okay.
a multi-donor, well, it's actually a designated fund, which serves like a multi-donor DAF. And I have gotten some early commitments that way, but I guess my questions are, one, is it going to really hurt me for fund two if I have a meaningful amount of capital coming in through this strategy? And two, are there maybe more national sources of these DAF investments that I'm maybe not thinking about that I should be thinking about?
So are you an impact investor?
No, we're catalytic capital. We're not doing ESG related criteria. So
I just think it's interesting that you came from, you have investors from impact assets. So I don't know a lot about DAFs. When I was in the asset management world, we didn't have a DAF on our platform. This is a donor advised fund, which is like an alternative to, if you don't have kind of enough assets to endow a family foundation, you kind of do a family foundation within a vehicle that is structured by a bank or another asset manager, and it's called a donor advised fund. So I don't know very much about DAFs. I have a friend that I can connect you with who is a GP, and she's like all about this angle, and she's always talking to me about it. So I'm happy to connect you with her. She's really smart on this. And she is very connected to a lot of family offices as well. So I'm going to put my email in the chat, and if you email me after, I will connect you with her.
Thank you.
I think that's a really interesting story. I just worked with a client in a fractional COO capacity, Inspire Access, where, they're mobilizing philanthropic capital to invest in funds and startups that are run by women and people of color. So very clear impact focus there. But that was my whole introduction to the world of philanthropic capital as it pertained to the investment space. And I think it will provide, just my perspective, again, not being a placement agent, so someone who would not have to sell your fund, but I think that's an interesting story. Do you, Jessica, do you think that sounds at least something that would be looked on as a positive in terms of like a differentiator or like, a more diversified LP base kind of thing?
Well, I think the person you were working with, Vonetta, it sounds like they were like the investors in that fund or company. They could have been considered a program related investment, a PRI, which is another way to leverage philanthropic capital is like, okay, if you think about a philanthropy, there's two sides. There's the grant making, which is giving away the money. And then there's like the investing side where, you're keeping the corpus of the assets growing and productive so that you can keep giving the money away. And there's this minimum, there's minimum grant levels. I think it's like 3 or 5% a year. A program related investment or a PRI kind of sits in the Venn diagram between the investing and the grant making. And it sounds like some of the investors that you're talking about were maybe getting credit for that. So you get grant making credit and you get to earn a return. And it can be a market rate return, but if it's like impact oriented or like there's different ways to structure it, whether it's around like there's different like biologics and life sciences applications for program related investments. And some philanthropies are like really into that and they're really smart about it. And it's a thing that you have to deal with your accountant. And there's a lot of tax considerations, like, to do it right. I don't know if anyone wants to build their business model in that way because it's like so niche-y, but Desiree, you might know more about this.
I don't know if I know more, but I am pursuing it with one large foundation here because it's their preferred method. But I would say the vast majority of more established foundations who have large endowments are not that excited about PRI because they kind of live by the philosophy that the endowment should grow as fast as it can so that we can do as much programmatic good. And so they're using it sparingly as a tool. And I think what's happening more frequently is that a portion of the dollars are getting spun out into DAFs, either at a community foundation or at one of the big, Fidelity, Schwab, wherever's, and they're using that to support emerging fund managers, but avoiding the potential of not having the same kind of outcomes on their main endowment. So that's what I'm starting to see. So I think it's a growing trend, but it's, I think it's billions of dollars that are sitting in DAFs right now that are kind of getting robo invested in public markets. So there's a lot of available capital. And so I can't imagine it's going to be a ding for future, but I also realize that, we don't know what the market's going to look like in 3 or 4 years.
Yeah. And what do you mean by a ding? Like when you go to raise money again, like LPs will be like, oh, that's kind of funky. Like, how come you didn't have different types of LPs or?
That, my actual hope, and I'm just kind of more sharing this than I am asking a question at this point, is that by giving these family offices visibility through a more kind of patient or risk tolerant pool of capital, that they'll be more inclined to come in on the next fund with their return seeking capital. But, it could also signal to other investors that no one's actually willing to take the risk on this with their return seeking capital and everyone's coming in philanthropically. Although I'm not seeing that happen entirely yet. But I'm just getting started. So.
Yeah, I think you're a first time fund manager. Yeah. This market is so brutal and it's so like, it's just a really, really tough fundraising market. So I think anyone that raises money in this market, other LPs in like the next cycle will be like, oh my gosh, you made it. Like you survived and like you raised money, whatever, like by hook or by crook. So I don't think it will look
crook.
Yeah, exactly. I'm
Yeah, I understand.
So it's like you raised money, you deployed capital. This was like the first thing we talked about is like, maybe your fund size needs to shrink or like, it's like, what's your minimum viable fund size that you can execute your business plan on and like, have the fewest amount of people and the most outsourced kind of least expensive support resources so that you can do a proof of concept fund. And I think that is going to go a long way to show like what you're able to do in a down market.
Yeah.
regardless of where the dollars come from.
And you'll be, if I'm remembering correctly, there's roughly $234 billion sitting in DAFs unallocated, if I'm remembering that correctly. So
Wow.
all the favor of, shaking down some money that's just generating fees for really big companies that don't really need them. But that is a different platform for a different day. But thank you all. We're just gotten to time, and I kind of can't believe it. Of course, I have 1,000 more questions, and but I want to thank Jessica again so much for her time, especially feeling under the weather, for giving us so much really, really insightful information. I think I feel a lot more educated about where the market is now, where it can go, and a lot of dynamics that I wasn't wholly familiar with myself. So thank you so much again, Jessica, and thank you, Evelyn and Desiree, for your really brilliant questions that were also very educating for me.
Thank you, guys. Thank you, Vonetta. I really appreciate you asking me, and it's really nice to meet you. Helen, I met today for the first time on Zoom, and Evelyn and Desiree, nice to meet you as well. And, best of luck with everyone's fundraisers.
Definitely. Well, I hope to see you all. Next roundtable will be on June 5th. I'll be talking with Lauren Colonna from Ovis Creative. So talking about the state of fundraising and how to fundraise in a terrible market isn't fun, but talking about how to create a really great pitch deck is also fun. So really looking forward to talking about the branding and marketing and all of that goes behind a really great shop. So thank you all so much again for being here. Hope to see you next time.
Yeah, see you soon. Okay, take care.
Thank you, Vanessa. Bye-bye.
Bye.